You may not be as diversified as you think. Check this out. Here are the 5 largest growth stock ETFs in America, according to ETFDB.com. The largest, of course, is the PowerShares QQQ. Its 5 biggest holdings are, in order, Apple, Microsoft, Amazon, Facebook, and Google's Alphabet. They make up 44% of the entire ETF if you include both classes of Alphabet stock. And I want you to keep those 5 stocks at the front of your mind, because the IWF Russell 1000 Growth ETF, the number 2 biggest, has the same top 5 stocks that make up about 24% of the 552 holdings there. Next up is the VUG. This one a little different, but only because it subs in Home Depot for Microsoft. Other than that, the 4 biggest stocks are the same. You're starting to see a trend, right? The 4th biggest is the iShares S&P 500 Growth, IVW. 26% of its holdings are, you guessed it, Apple, Microsoft, Facebook, Amazon, and both classes of Alphabet. Finally, you've got the Schwab U.S. Large Cap Growth ETF. 23% of its 404 holdings are, yep, Apple, Amazon, Facebook, and Alphabet. But instead of Microsoft, it does feature Warren Buffett's Berkshire Hathaway. So if you're thinking about buying any of these and you're wondering which might be the most diversified based on the least concentration of stocks at the top, well, it's not the QQQ, the most popular one. 61% of its weight is just the top 15 stocks. The least weighted to the top is the IWM. Its 15 stocks make up just 36% of that weighting. All right, let's talk more about this. Joining us really is a legend in the industry is VanEck, CEO of VanEck Associates. They have a number of ETFs, none of which he will tell you are levered. And Jan, I'm not trying to scare anybody. I'm not saying these are bad things. These have done a lot of good for a lot of people. But what I'm trying to point out, and tell me if this is bunk or something, which is that when you've got just a couple of big names running the show in these ETFs, if investors decide that Amazon or Apple or whatever is overvalued and start to sell it, do you think it would have the power to bring down basically much of the market, just a couple of stocks?
Well, there's so many things going on in your question. Let's just talk about tech stocks. Really, we're in another tech mania. It's almost similar to the bubble of 98, 99. And I say that because it's gone way beyond the names that you mentioned. If you look at China, IT in China is now the largest sector of their market, and it's now a bit more important than the state-owned banks. So that's number one. Number two, obviously, the tech phase of Bitcoin and distributed ledgers, right? They exploded and brought in so many investors that Coinbase has more investors than Schwab does. They have 15 million. So that's a tech mania, right?
But he's asking about
way
structure more than anything.
Yeah, exactly. Those 5 stocks, okay, those 5 ETFs are about 160 billion of total market value, which is not nothing. And what I was trying to make the point is that you've got just a couple of stocks that are really running the show. And I don't think a lot of investors realize, oh, I'm by the QQQ, it's over 100 stocks, I'm well diversified. But really, if 2 or 3 stocks move, the whole thing is going to move, and it doesn't matter how well the other companies are doing.
Yeah, I was just trying to address the point that the mentality of investors today is 100% all in tech mania. And I'm just supporting your point. So the question is, how can these stocks hit a wall? It'll be something completely unexpected. Now, they're unbelievable cash powerhouses, right? I mean, it is unbelievable. Their market share and their cash generation is the envy of everyone. So you have regulatory risk that's out there, and, you know, I don't know, maybe distributed ledgers can challenge them at some point,
but
right?
Brian's major point, I think it's a really critical one. For anyone who invests in an ETF or a mutual fund, you need to know what is in it.
Right.
Right? And you need to, as the Dow goes negative right now, or now it's back up a little bit, we look at, you need to know what's in it and what the dominant stocks are. Because if you think automatically, because you're in some kind of indexed product, that you are not in a concentrated portfolio, you may be wrong.
You have to know what you're buying. Absolutely. But, you know, the investors aren't necessarily going to agree with all that. Some say you need to have a concentrated portfolio, right? Have conviction in what you own.
But you need to know and be comfortable with the idea that 5 stocks are 40% of your portfolio.
And the idea, a lot of people buy several ETFs or several mutual funds. They may have different names and different missions, and ultimately you look at them and
the result is,
lo and behold, they all own Apple.
You have a totally incestuous portfolio.
Right.
And to take the other extreme, energy stocks as a percentage of the S&P are almost at historic lows. So, and that's a hatred going on to those stocks. I totally agree. When the mentality changes, can the bull market in stocks generally survive a tech market correction? I don't know the answer to that, but that's a great question.
Well, that's the point we're trying to make, is that if it does correct, that it's going to bring things down. I mean, I think to Michelle and Tyler's point, the XHB, which is a home builder, it's got home builder in the name. The 7th biggest holding is the first home builder. It's got like Whirlpool and Bed Bath & Beyond before the first home builder. So when you guys structure ETFs,
right,
how do you make sure that it's an attractive thing? You want people to, it's got a catchy name or whatever it is, but that it accomplishes the goal that the buyer, who literally may unfortunately be buying on the name, don't do that, but if they did, that they accomplish the goal that you want them to?
It's really important. It's our job as ETF issuers to earn the trust of our clients and to describe what's actually in the portfolio so that if investors buy something for a reason, they're getting that. So the way we do that is we have a 50% revenue rule. It's what we call the pure play rule. So the constituents in an ETF have to get more than half of their sales from the activity that's described in the ETF. A coal company in a coal ETF, for example. So there are plenty of ETFs out there, to your point, that are completely confusing and misleading. And you have some of these blockchain ETFs that came out recently, and they include Goldman Sachs and Bank of New York and all these names, and you would be challenged to find 0.5% of their revenue associated with the blockchain.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.